Okay, so here we are on the second day studying valuation of receivables, both accounts receivable, notes receivable, Chapter 9, Accounting 202. I want to mention, was asked how to interpret the learning objectives in the back of the book, and so here's a picture of the ebook, and you can see the learning objectives are listed over here on the side, P1, P2, C1, A1. You just look at the ones I assign. I assign them by letter, number. Those learning objectives come from the beginning of the chapter. Let's see if we can take a peek at them here. Here they are. The C's stand for conceptual, the A's for analytical, the P's for procedural, and it tells you at the beginning of each chapter what the specific objectives of this chapter are. So that's how I assign them. I do that to enable us to continue to use old editions of the textbook a little bit longer, so it kind of helps the overall issue of cost, because when they produce a new textbook, the questions and exercises get all scrambled. And so by assigning them through learning objectives, I can keep on track and be consistent without too many references. Okay, so we're back to this notion of valuation of receivables. We went through this whole issue yesterday of developing this notion of an allowance account, because FASB and GAAP do not like you to directly get rid of or write off or take out of your accounts bad debt when you discover it, because they say, well, oftentimes that debt was earned in a different fiscal period, and as a result, you're going to have a mismatch of revenue and expenses. Over here on the income statement, the matching concept says if you have revenue, you've got to record all the expenses that are associated with that revenue. And bad debt expense is an unfortunate but necessary expense that you have to deal with if you're going to sell on account. You cannot get away from it in the business world. Some folks inevitably can't pay you, and so you have to have a way of dealing with it. So you say to yourself as a student, well, how do I know which ones aren't going to pay me? When I sell it to them, I certainly wouldn't sell it to them if I knew they weren't going to pay me. How do I match it up? And the answer in accounting is you guess. You take a guess about what your level of bad debt will be. And a new account pops up that we have to use in that regard. It's called allowance for doubtful accounts, allowance for uncollectible accounts, allowance for bad debt. It is a way of reducing the carrying value, the weight of the receivables on the balance sheet by the amounts that you expect will never come back to you in cash anyway. By guessing, we know we're not going to be perfect, but we know we're going to be a lot better off than if we just ignored the problem as far as honoring the matching concept. And so the technique of guessing is something we'll have to deal with and we'll have to learn, but it's an important requirement of FASB. Here we saw how we would initially record bad debt expense if we adopted the allowance method. Now remember, the comparable for the allowance method, or the counterpoint, is the direct method, where we don't ever try to guess about bad debt. We just wait and wait and wait until it actually happens to us. We get the bankruptcy notice and then we write it off. So not true in the allowance method. You're trying to guess about what the future is going to bring to you in bad debt, and we do it in the adjusting process at the end of the fiscal period. We're trying to tune up our accounts, get them ready to produce an accurate financial statement set. We have to get our bad debt put in there. So we go through an analysis. We're going to learn how to do that in a minute, but that analysis inevitably comes up, you come up with a number, and you say, in the allowance account, I expect $2,500 of bad debt to be resident in the work we've already done, in the sales we've already achieved on account. And so the journal comes open, you list an adjusting entry, and you create an expense. You reduce your net income with that expense, even though nothing has happened in cash yet. Nothing real, no third party has notified you they're not going to pay you. This is just an accountant doing a calculation and says, I know we have bad debt expense inherent in our numbers right now. I'm going to quantify it, and I'm going to put it into the accounts. Bad debt expense, $2,500, matching entry to credit side is in the contra asset account allowance for doubtful accounts, or allowance for uncollectible accounts is the term used in this presentation. So we see the T accounts down below. It's posted down to the ledger, and we see it appear as a credit balance right down here in the allowance account. There's our ending credit balance. There is our bad debt expense recorded at the end of the fiscal period. Now remember, you're going to produce your financial statements because you're at the end of a fiscal period. You're going to close your accounts to start a new fiscal period. What's going to be down in bad debt right here? What is this balance going to be after closing? It's going to be zero. It's going to be gone. You're going to start out with a clean slate in the new fiscal year. No bad debt in that year, the day you start. But the $2,500 in the allowance is a permanent account. It's sitting on the balance sheet. It's there and it's available to you. So how do we use that? Remember, we deal with it in the future then when the actual events are made known to us that tell us one of your customers won't pay or can't pay. Here the dog says, after a year of getting lattes on account from the proprietor, says, gosh, you know that $1,000 I owe you, I'm broke and I'm leaving and I'm not going to be able to pay you, sorry, but don't you have an allowance for me? She does. She doesn't like the fact that she has to use it for this particular customer, but it is what it is. And so she opens up her journal when she learns this and tells her accountant to do this, and away goes the dog receivable. See the credit entry to the dog receivable account, Mr. Dog receivable, $1,000 credited. That wipes out that asset. That's gone. The valuation is gone. What's the offsetting debit? The mistake you would make as a student studying this on a test or getting ready for a test is you would say, oh, well, that's bad debt expense, isn't it? I'm writing off a bad account. Isn't it an expense? Answer, no, it's not an expense. You already expensed it. You expensed it when you prepared your adjusting entry. So with the allowance method, we don't create bad debt willy-nilly. We don't do it when the events happen. We do it to prepare for the events happening. And so we're going to debit the allowance account here. Remember, the allowance account is a contra asset. It has a credit balance in it. See that $2,500 credit balance down there? That's what it had right here before we started. We hit it with that $1,000 debit. It's gone. We've now used up. We've used up $1,000 of that allowance. Now here's an important idea. Test question. The result of this write-off, what did it do to the net realizable value of receivables? Now the net realizable value, as we saw yesterday, is the total in the accounts receivable control account minus whatever is in the allowance account. That's the carrying value called the net realizable value. The result of this write-off, what did that do to the net realizable value of accounts receivable for this company? Can you think about that for a minute? What would it do? It reduced those debit entries. That accounts receivable has a big debit balance. It made that smaller by 1,000, but it also made the takeaway amount smaller by 1,000. The result of this transaction is no change in the net realizable value. When you hear that at first, or you saw it at first, you'd say, how is that possible? But if you did a little example, you would see that that's exactly what happens. I reduce the total receivable amount, but I also reduce the amount I'm taking away from those receivables by the same number. The result is the net amount doesn't change. That's by design. That's what the accountants wanted to have happen. Does this event here affect net income? No. Doesn't even get close to the income statement. It's sitting right over there on the balance sheet, and you're dealing with those accounts right on the balance sheet. And so by design, the allowance method, if you have an adequate balance in the allowance account. Now, you can get into situations where you goofed, you didn't put enough in, and you have this cascade of bad debt. But let's assume you have adequate balances in it, normal operations. When you do the write-off, it doesn't change anything. A reader of your financial statements could maybe dig in and find out that you had written off an account, but the gross numbers they look at, net income, total assets, total net realizable value of accounts receivable, it doesn't change. It doesn't make any difference because you use that buffer, that allowance account, to deal with it. So that's an important idea. That'll get you a test question pretty easily if you think about it. All right, write-offs do not create an expense when you are in the allowance method. Yes, question. Recording running. Okay, here we go. So as I showed you yesterday, when you set the allowance amount at the fiscal period, in this case we put $2,500 in, and I'm going to explain how they came up with that in a bit here. But that $2,500 fills up the allowance. It's the takeaway from receivables. It's a bucket. It's a reserve. Banks use that word to describe loans receivable. Their allowance, they use a different term. Often they call it loan loss reserves. But it's the same technique. It's a way of assuming losses that are going to happen in the future and getting them into the accounts right now. When you do the write-off, when the dog tells you, I'm not going to pay you, bye, you have to get rid of some of your allowance. And that's why that debit entry there of $1,000 is causing the allowance to be used up, to spill it out a little bit. So those are the dynamics. That's the design of the allowance method. It's important because it's really honoring that matching concept. It's matching up the bad debt expense with the revenue that you earned with that cost. And in the future, it's trying not to have the subsequent write-off events affect the accounts in total. They do affect the accounts, but they shouldn't affect net income. They shouldn't affect net realizable value of receivables or total assets. Okay. Let's move on then, and let's figure out how we compute that $2,500, for example. Where'd you get that? Where does that number come from? This is difficult. This is the most difficult part of this chapter. It's complicated and confusing. We're going to try to make it simple for you, and we'll see how we do. Okay, so we have this challenge of determining how much should we put in the allowance account at the adjusting point. Answer is we guess. We already knew that it was a guess. What's the basis of the guess? Your historical performance is the basis of your guess. You go back and you look and see, well, how much bad debt have we been experiencing over the past few years? Now, that's not too hard, but guess what? FASB and GAAP build rules by consensus. They ask everybody that uses the statements, prepares the statements, looks at the statements, what do you think we should have as a rule? They get back, I think it should be this. No, it should be this. It should be this. It should be that. They're very accommodating, and they very often come out with a rule that has options. You can either do it this way or you can do it this way. This is one of them. FASB allows you to guess about the amount of bad debt using two separate approaches. Hardest part of this chapter. Here we go. What are the two approaches? One is called the balance sheet focus. The alternative is called the income statement focus. I like to tell students when you first see this, when we use these, pretend that in between these two statements is a brick wall. You can't, if you're standing on the balance sheet, you can't see the income statement. If you're standing on the income statement, you can't see the balance sheet. That will help you deal with the problem that you're given, because when you're given a problem that will cause you to be worried about what's going on over on the balance sheet, or you'll be worried about what's going on over the income statement. I want to assure you, if you determine that it is the balance sheet focus, then get on that balance sheet and stay there and don't worry about what's happening on the income statement. If you're sure it's an income statement focus problem, you're standing on the income statement, don't worry about what's on the balance sheet. That's the one unfortunately, the one that we have the biggest problem with is the income statement focus. we try to consider the balances over here. And now, having said that, you probably won't really remember what I said until we do some problems. But let's go further here and see what's up. Let's start out with, this is what I consider to be probably the more difficult one. Let's begin with it and get it out of the way. Balance sheet focus. That simply is this notion of you got a balance in accounts receivable at the end of the year. Go look at it. Go back historically and look at the end of the year accounts receivable balances and track how many of those turned into bad debt and what percentage were those. What percentage of your end of the year AR turned into bad debt? 5%, 2%, 1%, 10%? Use that number again then. It's a good number. That's the balance sheet focus. You're not told in the problems, hey, everybody, this is a balance sheet focus. You're told the firm uses a percent of receivables to determine bad debt expense in the allowance method. You know when they say percent of receivables, they are talking about a balance sheet focus. All right? The alternative to the balance sheet focus, income statement focus. What do you use? Historical sales on account, not cash sales because they don't involve a receivable. Sales on account are of record. You can track those and find out what percent of those sales on account did not come back to you in full payment. It's of record. It can be, you can dig it out. Lots of accountants and staff spend time digging this stuff out for the accountants to put the numbers together. If you choose one, you don't have to use the other. The FASB said pick one and run with it. And so firms decide based on what they think the best indicator is. What they think the best indicator is. Now we'll go through these, and when we're done I'll tell you which one I think is the best one and why. But we got to learn them both. So let's march down through and see how it works. All right. Which approach? Well, it's which one is the best predictor is which approach we use. So let's push ahead. Let's do an example of percent of receivables. Here we have this notion that we're going to look at the accounts receivable. We're going to look at the historical amounts. We're going to try and figure out what turned into bad debt. We're going to use that in the future. Marsh cabinets. Looking back, it says that about 2.5% of our end of period receivables seem to turn into bad debt for us. So we're sitting at the end of the period now. We have a balance in accounts receivable of $88,000. We're going to say to ourselves that about 2.5% of those don't come back to us. So here's something very, very important. When they make this calculation, here's what they're saying to you. They're saying, when we're done with our adjusting entry, we want the allowance account to say credit balance of $2,200. Now, the other method that we're going to use, the income statement focus method, you're not saying that same thing. When we do our calculation with the income statement focus method, we're saying put that into the journal. Put that number into the journal. We're not saying that here. We're saying we want the T account for the allowance to have a credit balance of $2,200 because we're saying to ourselves that sitting there looking at that control account for accounts receivable, 2.5% of that balance won't come to us. So we want 2.5% of that amount sitting in the allowance account. Problem is, the allowance account is never going to be zero when you do your adjusting entry because no one is that good at estimating bad debt. It's going to have either a debit balance, we use more than we had, or a credit balance, we didn't use as much as we had. That's reality. And so when you're doing this and you calculate that number, that may not be the number you journalize because you may already have something in the account. Or you may have a negative balance in the account you have to overcome. So that's the hardest part of the whole chapter is dealing with this. Let's look at it now. We do the calculation and we say, oh, magically I had nothing in my allowance account. Maybe it was the first time they used an allowance account. Maybe it was pure luck. But here it is. It was zero, so they journalized the entire $2,200, created bad debt, bad debt expense for $2,200, credit the allowance account. They're done. They finished the adjustment for the allowance. You know where they got it now. Historical experience in bad debt based on receivable balances at the end of the year. All right, but what would have happened if there was a balance in there? What if there was $400 credit balance sitting in there? Would that happen very often? Well, yes, it happens constantly. That's the norm. No one gets it perfect. You can't. It's too big of a guess. But let's say it had a credit balance. It could equally likely have a debit balance. It's not unusual at all to have a debit balance in there. But it has a credit balance. You made the same calculation. Your calculation says, I want that account to say $2,200 credit when I'm done. Well, you better not journalize another $2,200. Just journalize $1,800. And that would push it up to what you calculated it should be. Do you see what the game is here? Now, guess what they're going to do to you on the test? They're going to give you a debit balance there. So what will you do? Well, you'll say, the amount I calculated, $2,200, has to be added to the debit balance. Because that debit balance is going to chew up that part of my entry. I have to have surviving amounts equal to $2,200. So you just have to think about it a little bit, and it will become clear. What's that?
It's just $2,200, whatever the difference.
But let's say this was a $400 debit balance. I would have to add $400 to $2,200. I would journalize $2,600, and it would wind up with a $2,200 credit balance. Don't be overly concerned about it, because we're going to do these problems, and you'll see it in real life. You expect it now, and you'll anticipate it correctly. Okay, so as we move on, then we see that we would have to change the journal entry to deal with what's sitting in that allowance account. Remember I said when you use the balance sheet focus, you're standing on the balance sheet, you can't see the income statement, but you got to deal with what's in that account, in the allowance account under the accounts receivable, and you look at it, and you're given that data, and you have to be given that data to decide what to do with the journal as far as the adjustment's concerned. Okay. Now, I want to talk about this idea here. I have to mention it to you right away. It's sort of an extra idea in the course. It's not something we do a lot of problems and we calculate these issues, so don't be concerned about it. But it turns out that in practice, it's not very accurate to say, you know, we always seem to lose 2.5% of our total receivables. There's a much more accurate way to deal with bad debt history. It's called aging reports. Now, if you were in banking ever, or you're going to be in banking, bankers live with accounts receivable aging reports. It tells the banker and it tells the firm that produces them how old your receivables are. Because logic tells everybody if it's a really old receivable, it's going to have a greater likelihood of not being collected. As they get older, the risk that you won't get it gets bigger and bigger and bigger. That's pretty obvious to everybody. So we usually get very sophisticated with analysis of accounts receivable, and we age them. Here's what it might look like. We picked these categories. They can be anything you want based on the credit terms you offer in the industry you're in, but we went current, meaning it's not due yet. It's past due 0 to 30 days, 30 to 60, 61 to 90. You pick the category. Computers do it for us now, thank goodness. QuickBooks Peachtree, $100 and free. Actually, you can get QuickBooks free now. They'll age your receivables for you. They just bam, they show you how old they are, how many dollars are in each category. But the important point for everybody is this middle column here, this percentage. This is historically what this firm has suffered in losses from those aging categories. The percentage gets bigger and bigger as the aging amounts get older and older. So you wind up with a much more accurate view of your bad debt history. The other thing aging does is it alerts you to business cycle changes much more quickly. if you simply took a simple percentage of total receivables and you entered into the recession we went into 3 years ago, you would not be paying attention to the fact that you're probably seeing many more aged accounts in your balances, and you probably better be expensing more than you're expensing. But if you went to this simplistic analysis of just the gross total and take 2.5% of it or something, you're going to miss that signal coming back to you from the business environment that times are tough, people are having trouble paying. So that sophistication that the aging report brings you is the gold standard. It's what everybody uses. People worry about this and work it and deal with it. If you have that pledged line of credit where you pledge your receivables to the bank and you advance against your balances, the bank often will say, you know, draw a line under 60 days here. We're not going to advance you anything on anything older than 60 days. Or the bank might be, in an industry you're in, they might be saying, no, nothing over 30 days will I let you advance on. And so that's how the bank controls their risk. They want to have this secondary source repayment, the receivables themselves, and they don't want to get too far above those. It's a conservative practice. Okay, so that's aging, and that helps us understand a little bit this method here. So here's a big picture of the balance sheet focus. Net value of accounts receivable, you set the allowance account for the amount that you calculate using a sophisticated analysis of the historic bad debt suffered by the balances in receivables that you're staring at. And so you're able to produce it, you're able to set those balances. And what's the problem with that as far as students are concerned? You have to consider what is in the allowance account the day you do the adjustment. Those allowance accounts are permanent balances. They don't disappear. You can't throw them away. You got to live with them. So sometimes you put less in than your calculation. Sometimes you put more, depending on whether it has a debit or credit balance. Now, the easier of the two methods is the income statement focus method. This simply says something logical too. It says, go look at the income statement. Look at the historic totals of sales on account, track those totals, and find out which ones didn't come back to you in payment. That's a pretty good percentage. So it's a straight percentage of sales on account. No cash sales, because they do not create accounts receivable. This little photography firm here says about 1.5% of our sales on account seem to not come back to us historically. We've selected this method as the method of choice. We think it's the best way to deal with our industry and with our information. And so when we make our adjusting entry, we want to expense $4,300 of our sales on account as bad debt expense in our adjusting effort. Now, we're saying something very different in this method when we make that calculation. We're not saying go look at what's in the allowance method already. We're saying we're standing on the income statement. We can't see the balances on the balance sheet. We're focused only on the income statement. We don't care what's in the allowance account. We don't care what's in accounts receivable. Our focus is entirely on sales on account. And our methodology is to use a percentage historically of those that resulted in bad debt, and we're gonna create that bad debt right straight from our calculation. So we open up our journal, and in goes the 4380. It gets posted to the allowance, even though, look, the allowance had a balance in it. There it is. We didn't care. We ignored it. What happens with students? The biggest mistake students make in this chapter on this test is they'll get this problem and they'll change that 4380. They'll reduce it by this amount because they're thinking of the wrong method. They're thinking of the balance sheet focus. Yeah. The problems don't say, hey, this is a balance sheet focus, or hey, this is an income statement focus. They'll say the firm uses a percent of sales on account. That's income statement focus. Or the firm uses a percent of accounts receivable. That's balance sheet. Okay? So now I've exposed you to the worst of this, most difficult part of this chapter. I've exposed you to the problem that you got to deal with I want to try to do a couple of those. So let me pause my recording here. Okay. So here we are on Quick Study 2, Chapter 9. We're trying to journalize a write-off under the allowance method. So you're doing October 31st. What accounts are involved? Yeah, the first one, the account receivable. That asset is no longer valuable. We got to remove it. How do we remove an asset value? With a credit, right? No, that's going to be a credit to accounts receivable, because it's normally a debit balance. We're going to credit it to get rid of it. So now we know one side is a credit to the specific account receivable. Where does the debit go? Now, remember when I said the common leaning that we always have as students is when we see we lost an asset value, we say we expense it, don't we? Whoops, not in the allowance method. We already expensed it. We just didn't know it was this particular customer. It's been expensed, inherent in the allowance account. So the debit goes to the allowance account here. So let's see a peek at the solution. Here it is. There it is. Down at the bottom, we see the allowance got the debit, making it smaller because it's normally a credit balance. The specific receivable got the credit of $750 here, removing that value. Okay, now let's go back and look at this next idea. I want you to see this because it's a test question issue. It's not discussed a lot in the text of the chapter, but it happened here. What happened if later Elwick found $400 and just wanted to do the best he could for his debts and sent it on? He paid $400 after they had written the account off. That happens. Now here, what you have to say to yourself as a student is, I want Elwick's account receivable record to show that he reinstated. The term used is reinstated. So I know that I've used some allowance that I'm going to put back, and I know that I've recorded a removal of a receivable that I want to put back, and I know I have to show that I received cash. I have to do all these things. So what you do initially is you reverse the portion of the write-off that you're dealing with. You're dealing with $400 of that $750 write-off. And this is a little difficult here, but you reverse this entry up here only in the amount of $400. So down here we see that we're debiting accounts receivable. We're putting it back into accounts receivable. And you're saying to yourself, well, why do that? Because they have the cash on their desk. Because we want that account to show the reinstatement history. And so we credit accounts, allowance for doubtful accounts, we put it back in there. So now it's available again for some other write-off. And we put it back into accounts receivable. And then 1 second later, what do? We say, oh, and this check I got on my desk, that's cash. Debit cash, thanks for reinstating, and credit off the receivable. So you put it in, and 1 second later you take it right back out. Some students would come to the conclusion that let's just do the debit to cash and the credit to the allowance account because the end result is the same. The trial balance would look the same either way. You could, but what you would do then is 6 months later, Elwick says, you know, I want to get back in your good graces and do business with you again. You know, I came back and paid $400, and I'm going to pay the rest. Well, if you went and looked at their account, you would say, no, I don't see any record of it. If you failed to do that reversing entry that I show you there. So, in the area of importance, this is a B, not an A in this chapter, but it's going to catch you on the test if you haven't seen one before. So that's a good example there of how you deal with a reinstatement. Reverse what you did earlier, and then accept the cash and go forward. Okay, so that's a write-off. Now we want to look at Quick Study 3, and that is estimate bad debt. These are the hard ones now. These are the ones where you have to think about the method. So here we are. There's Quick Study 3 right up here, Darius Company. Read that for me real quickly and see if you can start thinking about how we journalize this. So now that you kind of glance at the data, what method do they use? What term or phrase tells you what method they use? Answer, this uncollectibles are estimated to be 1.5% of accounts receivable. You know they use the balance sheet focus. It says so because of that statement. So I'm using the balance sheet focus. I have to be very careful to acknowledge what is in the allowance and to make my journal entry work with that balance to get my desired end result in that account. What's your desired end result? You want to take the $95,000 worth of receivables times 1.5%. You come up with a calculated amount. You say, I want that to appear as the ending balance in the allowance account, 1.5% of $95,000. So in the calculation, you're going to calculate it, and then you're going to subtract this $550 because it's given to you as a credit balance, meaning I already have $550 of the amount I need. I just need the rest. And you go ahead and you journalize it. So looking at the solution here, Quick Study 3, the calculated amount is $1,425 shown there. You already have $550, so you only have to journalize $875. Debit expense, the only time we expense bad debt with the allowance method is in the adjusting process. We don't expense it later on in write-offs. And we credit. We put some more into the allowance account, $875 more. Now it's got a balance of the $1,425 that we calculated. Fair enough? Now, let's change the scene a little bit here and say, what if it had a debit balance of $150 instead of a credit balance of $550? The accounts we use are the same. The debits and credits we give to those accounts are the same. The number changes. What number are you going to put in? You do. So plus 1425, exactly right. In other words, you get that 150 debit is going to eat up 150 of the credits you put in there. They're going to turn to zero. So you got to put more in so that you have a surviving balance of 1425. So you have to put in the sum of those. Here it is, 1575. If you journalize a credit to the allowance account of 1575, 150 of it gets chewed up by that negative debit balance in there. The surviving balance would be a credit amount shown right there. Okay? That's the hard one because you have to deal with what's in that account. You have to think about it. You have to try it a couple times. Say, is that going to do what I hope it's going to do? Let me check. And then you're comfortable with it. All right. Now let's move on to Quick Study 4 and deal with the sales on account method, income statement focus method. Let me bring that up. Just getting used to Windows 7 here. So, Quick Study 4, the same facts as Quick Study 3, except the firm uses a % of sales on account. What's going to be your adjusting entry in that case? What's going to be your adjusting entry? Given the same facts, you have sales of $350, and you're not told that any of those are cash sales, so you get to assume they're all sales on account. So $350 times 0.005, because it's 0.5% of sales on account, is the amount of bad debt you're calculating. Now, this is the question all students miss the most often. What they do then, they successfully multiply 0.005 times the $350,000, and then they go back and reduce it by the credit balance in the allowance account. Whoops. No, we don't do that. We can't see that account balance. Remember, we're standing on the income statement, got a brick wall, we don't care, we can't see. Yeah, you're going to give it to me, but I'm going to ignore it. So it's a direct calculation, and that calculation gets journalized. Because you're saying to yourself, that's my bad debt expense. When you calculate a percent of receivables, you're saying, I want to set the allowance to be that percentage. You're not saying that with the percent of sales method. So, in the solution here, we have quick study 4. The calculation is $17.50. You don't care. You can put a debit balance in the allowance, a credit balance. You can change the numbers. Doesn't change your journal entry because you declared that you were going to have $17.50 bad debt expense, and away you go. Okay? So now we thankfully have covered the worst of this chapter, and what we'll be doing tomorrow and Thursday is we're going to be dealing with credit card sales and notes receivable. Those two are not minor topics, but they're not as messy and complicated as the account receivable methods. What we went through today is what I would point to as the most often missed and most often difficult questions. So we'll see you all tomorrow.